Narendra Kumar, the CEO of Value Research, who helps us every week. Narendra, thank you so much for joining us. Let's get straight to our portfolio question. Anuj has written in. He's 29 years old, married, no children, Narendra. He and his wife managed to set aside about 80,000 rupees every month after expenses. That's the surplus. He wants to be able to create a contingency fund. He wants to be able to buy a home. He tells us he does have health insurance. The thing that worries me most of all about his case is that he's looking to buy a home worth 2 crore rupees in Mumbai over the next 2 or 3 years. Now, in all fairness, if you live in Mumbai, you know that that's what it costs to buy a nice home in this city. It costs 2 crore rupees, which means that he's going to have to borrow a lot of money, about 1.5 crore rupees he'll have to borrow. He tells us he has 25 lakh rupees if he manages to put that together, another 25 lakh rupees that he'll borrow from family. That seems like a really, really heavy commitment for people who only have about 80,000 rupees to set aside every month. Narendra, would you like him to re-look at this goal altogether, perhaps, resize it a little bit to suit his income?
Yes, absolutely. It is beyond his budget. Looking at it, if he's going to borrow 1.5 crore, and even a 25-year loan will cost him about 1.5 lakh rupee EMI. Which is twice as much as his surplus today. So in that sense, it is unaffordable. Beyond that, and not only that, he will be saved from, he will be prevented from doing any other saving or accumulation just in case he needs that money. So my suggestion to him will be lower his budget, lower his scale of, home which he plans to buy. That apart, he should defer his plan. He should plan it in a manner that first he should start accumulating his savings, make his savings grow faster. And at some point when his own contribution is about 35–40%, not 25%, of the house which he plans to buy, and he's approaching that, he should start looking for that house once he has been able to accumulate about 50–60 lakh rupees. Then he should start looking for it, and there is a possibility that he might be in a situation that he can grow his income. That can alter his situation completely.
Well, obviously, Anuj, this is a trend we're seeing across the country where young people want to buy houses at the age of 28 or 29. Now, it's a good goal to have, but obviously you need to match it to your current income. And we do hope that over the next 2, 3, 4, maybe 5 years, your income grows exponentially and you'll be able to afford that home. But in the meantime, if we just look at the numbers are not adding up. Narendra, he also wants us to take a look at his investments right now. He's putting aside about 1.2 lakh rupees, he says, in SIPs, HDFC Equity, HDFC Prudence, HDFC Top 200, and the IDFC Premier Equity Plan. Let's talk about the overlap here. 3 funds from the HDFC group. All of them have a considerable overlap, and this is something we've talked about in the past. Would you like him to pick one of our portfolios instead?
Yes, absolutely. He should look at our aggressive growth portfolio seriously. Not only that, he should just worry about his emergency fund or his contingency fund and keep that money aside and save as much as he can and put in this aggressive portfolio as much as he can, and for as long till he is accumulating. And in between, if he gets lucky, if he is able to increase his income, if he is able to provide more in this plan, possible that he can get closer to buying his home.
But you will be able to move closer and closer to buying your home as you increase your contribution. And Narendra, they're recommending our aggressive growth portfolio for you. But remember, the basics of the portfolio remain the same. You have to have an emergency fund. You have to have life and health insurance for both earning partners. And then you start making your investments. It will help you with buying a home. Stay in touch with us. And as you build your corpus towards that down payment and relook at your targets, we'll be here to help you out. Let's move on now to our hold or sell segment. Dr. Vishwanath has written in, Narendra, he's 44 years old, take home of 1.75 every month. He has a term cover of 2 crore rupees and a family floater plan of 15 lakh rupees. He tells us his aim is to create a corpus of 5 to 6 crore rupees for his retirement and his child's education over the next 20 years. He wants to know if these are the investments that will make that happen. Right on top, the Franklin India Blue Chip Fund, great fund, large cap fund. Over 20 years, is it a little too specific to large caps, Narendra?
Yes, Franklin Blue Chip is an impressive fund, and one has to look at it in conjunction, what all other investment he has. If this is the only large cap fund, I think it's a good fund to have.
Well, the next fund on his list is a Tata Ethical Plan, Narendra. We don't see this on too many portfolios. Given his time horizon, would you recommend he continues with this fund?
Yes, this fund has done exceptionally well for a variety of reasons. You know, it's a Sharia compliant fund, and there are certain omissions from this portfolio by its design. It has done well, but you know, I don't think that should be the primary driver. Going by the design of this fund, it keeps away from certain sectors, and it is, which means that it is more tilted towards consumption and many other keeps away from finance. So that has come in handy for this fund. Overall, it has done well, but it is not this kind of approach. A constrained portfolio is not a nice way for somebody to diversify for the long run and if you want a low maintenance portfolio.
Well, obviously, if you pick a fund like this one, which is low on finance or actually has no financial services companies at all in its portfolio, in a market where financial services does well, you'll find that the returns here are lacking. The next on his list is the IDFC Premier Equity Plan. They either continue with this investment?
Yes, continue with this investment, and it has been an impressive fund. It's changing its complexion. Hopefully, it's right once again.
Well, I'll take the next three funds together: BNP Paribas Mid Cap, HDFC Mid Cap Opportunities, and BNP Paribas Equity. I'm assuming there is a small overlap at least between the first and the third fund. And should he have both of those mid cap funds in his portfolio?
Not really. The first and the third fund has very little overlap because it's very well articulated. And mid-cap fund remains a mid-cap fund, and there's a small allocation, and so overlap may not be very significant. Yes, given his time frame, and you know, which is still 15-20 years away, his portfolio should have tilt. Now, the key question to ask here is that should he be choosing the mid-cap funds and the large-cap fund and combining his portfolio and maintaining the allocation himself, or should he choose a fund which will take care of it on its own? A fund which will be investing in mid-cap, large-cap, small-cap, depending on the situation, depending on the conditions of the market, and he can be hands-off from this portfolio. Looks like, you know, he has chosen a large-cap fund, a mid-cap fund. This may not be a very a great way of managing your portfolio. When you choose a fund, ideal situation will be you choose a fund with good track record, a wise fund manager, and a fund which has ample flexibility to move your money around, which is most opportune. And the fund has a demonstrated ability. From that standpoint, his portfolio will require maintenance. He will have to move his money from large cap to mid cap to something else, depending because something which will work will go up, the allocation will go up, and he'll be disappointed with the others. But there might be a situation that, you know, every segment of the market is cyclical. Things may not work out, or if you are prompted to change simply as a result of disappointing performance, it may not be the right time to exit that particular position. So I would suggest go for flexible mandates, a fund which is not very tightly or not very tightly configured to function in a very narrow way.
Right, the advice that we always give on the show remains the same. If you have a long-term horizon of 10, 20, 15 years, you need to pick a fund that can move freely across the market without being constrained to any sort of capitalization or any sort of theme. Narendra, he has one very quick question for you. Now, given the fact that you know the rest of his portfolio, would you recommend one tax-saving fund that he can use in order to avoid tax as well?
Yes, one should not leave the tax if one can avail the tax benefit, and this year it has been enlarged to increased to 1.5 lakh. Choose from our selection of tax-saving fund, the Axis Long-Term Equity Fund, or the ICICI Prudential Tax Plan, or the Quantum Tax Saver.
All right, on your screen right now, 3 tax saver funds that you can use to save tax. Remember, across the board, irrespective of your age group, if you're looking to save tax, then ELSS is probably the most efficient way to go. And here are your options on the screen right now. Let's take another question. Shankara Narayan Kandaswamy has written in Narendra. He's retired and he tells us the interest income he receives from his investments put him in the 20% tax bracket. He wants to know if he should buy the LIC Bima Bachat plan to save on tax. Now, here's the thing about the Bima Bachat plan. It's a money-back policy. We don't know what the charges are. It's completely inefficient, especially for someone like him. And to make matters worse, it's a single premium plan, Narendra, which means that he's going to have to save tax again next year. He'll have to buy a different plan altogether, pay charges again, pay commissions again. Completely unsuited for someone at his age. And even if he was a younger person, it's a very, very inefficient plan. What would you recommend he does to save tax in his age group?
No, for somebody like him who has so much interest income, which means he has so much of investment in fixed income or fixed deposits, or something like fixed deposit, that he is falling in the 20% tax bracket, and which means that even though he is getting the return and it is translating into taxable income, his money is effectively going down in value because even despite the high interest rate, it's not able to beat inflation. So it's very important for him to invest in a manner that a part of his money gets into equity. He should consider ELSS, invest to the possible extent. Maybe in 3 years' time, he will be in a situation to recycle his ELSS. In his retirement, if he's able to earmark only 1.5 lakh rupee, maybe he gets into a lower tax bracket, or is able to save taxes altogether. That will be a very happy situation. 3-year holding period, and having a 5-6 year view, he will not be disappointed with that. And it is not a matter of disappointment. I think it's important for somebody like him to have some allocation to equity, which will compensate for the declining value of his fixed income investments.
All right, and of course, if you have any more questions, you can get back in touch with us. Narendra, another retired viewer, has written in. M. Madhusudan is retired. He wants to know if he should exit the funds right now that he's put on his list, or should he wait for Union Budget 2015? I'm not really sure what he's expecting will happen in the next Union Budget, but these are the funds he has in his portfolio right now. He has the JM Agri Infra Fund, the JM Basic Fund, the Sundaram Energy Opportunities Fund, and the Sundaram Infrastructure Advantage Fund, all thematic funds. And I can understand why he's getting nervous, because they're all possibly not performing very well at this point. What should he do, Narendra, especially for a retired person? Should he be in these specific thematic funds at this point?
No, not at all. He should have actually got a fix on this earlier, and he has done all the waiting. Maybe this is a good time for him to exit all these funds. There is no reason why he should wait for the next Union Budget to time his exit. These are old investments, and these are now 4 or 5 year old investments. Fortunately, as a result of this budget announcement, the market has gone up, and some of these funds have also gone up much more than the overall market. So he should square up, despite his disappointment, he should take his money out and invest in a more sensible manner. Maybe he should take all his money out, maybe add some more money, and replicate our stable growth portfolio. That is just the kind of portfolio which is suited for a person like him. It provides growth with stability. At the same time, a big decline in market, it will always remain diversified. It will be relatively more stable than a big decline in the market, which we see in the market. And these funds are disappointing. They were invested these funds were launched at a time when the market was in a very different phase. These funds were going up very rapidly, and they crumbled, and they have struggled to make a comeback. Fortunately, in the last 3-4 months, some of these funds have done very well. Good time to plan his exit.
All right, it's a good time for you to plan your exit right now. And like we keep saying on the show, try and spread your money into equity diversified funds that are not limited by any theme. That would be the best way to go. It's time for our product review, and specifically on that note, we're looking at the ICICI Prudential Dynamic Fund this week. Avan is here to give us an introduction. Avan.
Thanks, Faye. Well, the ICICI Prudential Dynamic Fund is called Dynamic as the fund has the flexibility to invest across large, mid and small cap stocks without any restriction. This dynamic asset allocation helps the fund to move money from equities to fixed income securities depending on market conditions. Now, as an investor, if you are worried about putting your capital at risk, especially when you're investing in the market, this fund is designed to cushion its fall better than its peers. The fund philosophy ensures the fund performs better compared to its peers when the markets fall, even if the strategy hurts the performance during the up markets. The strategy helps the fund in getting good gains and ensures a robust performance over a market cycle. Its ability to move to cash in a timely manner has come to the fund's aid several times, especially in 2011, when the equity markets were extremely volatile. The combination of relatively high mid and small cap exposure along with the protective asset allocation is clearly a potent combination, and its superior stock selection has helped the fund's strong track record, bringing its investors impressive gains. Let's do some math to give you a better picture. If you invested 1,000 rupees in this fund when it launched, you would have 16,867 rupees today. So should this fund be a part of your portfolio? Let's find out. With that, it's back to you, Faye.
Thanks, Aman, for that information. Narendra, ICICI Prudential Dynamic Fund, and this is the thing you keep telling us about, that we should not limit ourselves to any sort of theme, any sort of portion of the market, whether it's large cap or mid cap. We should use a fund that has flexibility. Is this the definition of that flexibility? Would you say that if we had one fund to choose in the market, this should be it?
It has proved to be a very impressive fund, but more importantly, rather than the return, I think it's the consistency of performance. If we look at, last 7-8 years, it has always been able to beat its benchmark. It changes its color. It has all the flexibility. And the flexibility is reasonably well articulated. I'm getting quite impressed in the last 2-3 years with its the way the fund has gone about, the way the fund has stated what it will do, and it has gone about doing it, and that has worked. So in that sense, the consistency that is derived from a process is quite impressive. Of course, I would not like to take away the selectivity or the contribution of the fund manager in making the choice or constructing the portfolio. But the overall framework, the way the fund will actually change its complexion depending on the state of the market, and that seems to be working, and it has worked very nicely for the fund in the last 4-5 years.
Narendra, if we have to pick one fund right now, for those of us who are looking at our core portfolio, would you recommend that this is a must-have in all of our portfolios? Yeah,
this is one such fund. It is a good fund to have if you're going to have one equity fund in your portfolio.
All right, so the last time we reviewed this fund on the show, Narendra, you gave it 4 stars. Would you like to upgrade it given its performance over the last year or so?
Yes, it is only gaining strength in terms of the numbers it has been able to deliver. Also, I'm getting more convinced of its own belief or its rigor in following its own process.
All right, 5 stars there for the ICICI Prudential Dynamic Fund. Let's move on. A quick question. 35-year-old James Pinto has written in, Narendra, he has a monthly take-home of 2 lakh rupees. He can save 80,000 rupees every month. He wants to invest 25,000 rupees every month in mutual funds for 10 years to create a corpus of 12 crore rupees. He wants to know where he should invest this money. Now, the thing about his investment and his goal is he might not be able to make that goal unless the equity market does some phenomenal things, which they might do, Narendra. Would you recommend he invests in our growth portfolio?
First, a bad news for him. 25,000 rupees a month for next 10 years will have to produce 31% annualized return for it to become 2 crore. So unless he is willing to, contribute more, it can't happen. Assuming that, his money is going to earn 15% over the next 10 years, then a SIP amount needed will be about somewhere between 70 to 72,000 rupee. So he should keep in mind, of course, even that 15% on an average will be twice as much as the fixed income return that can be derived in India. So from that standpoint, I think, accumulating it to 2 crore is a very aggressive goal. He should think in terms of increasing his contribution, increasing his savings, which he should be able to with rising income if he is contributing more over time. And the way to achieve it should be, maybe 1 or 2 funds from our growth portfolio.
Right, 1 or 2 funds from our growth portfolio, and of course increase your allocation if you want to very specifically meet that goal of 12 crore rupees. Narendra, thank you so much for answering all of our questions this week. It's been a pleasure to have you on the show. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. We brought in Gaurav Mashruwala this week as well to answer the questions you sent in. Gaurav, thank you for joining us. Our first question comes in from Vijay Sharma. He's 48 years old. He plans to retire in 9 years and he will get a pension from his employer. He tells us he has a lump sum amount of 10 lakh rupees. He wants to know where he can invest it to gradually create a corpus after he retires. He wants to know if the ICICI Prudential Liquid Fund is a good option to start an STP. Gaurav, if he does have that much time on his hands, I would recommend he takes a look a little bit at least at investing in equity. What would you recommend he does? What sort of an investment should he be using at this point?
Sharma ji, what you should keep in mind is that STP now, when you are transferring money, there could be tax implications. So you have two choices. You are very clear that your goal is more than 7 to 9 years away. So transferring money from debt instrument into equity fund is an ideal way, and that's the way you have even thought about. Now there are two things you can do. Number one, what you can do is you can transfer this money over a period of 2 years. The amount of money which is going to get transferred in first year should be parked into a liquid fund or a short-term fund and keep doing an STP, because here you will end up paying short-term capital gains tax. But even if you were to put this money in a sweep-in account in bank fixed deposit and a savings account, you are going to pay same rate of tax. Money which is needed after a year, that money should go into definitely a fixed deposit. Ensure that that money is locked in for a fixed deposit, so you get to earn higher rate of interest. After that, take out that funds and bring it into liquid funds and do an STP. While you will not save on tax, what will happen is money parked into fixed deposit for a year has better probability of earning higher returns compared to that money parked in liquid fund.
Our next question comes in from Pulkit Khandelwal, who can invest 2,000 rupees every month with a time horizon of 15 to 20 years. That's really nice that you have such a long-term horizon. He wants to know if he should invest in a life insurance plan or should he use mutual funds. Gaurav, first of all, if it's such a nice SIP-like amount where he's putting in a certain amount of money every month, I would prefer that he uses a mutual fund. But what's your advice?
Mr. Pulkit Khandelwal, keep in mind that when we put money into insurance, it is not an investment. It's just to cover the risk of death. Insurance premium is an expense. When you do an SIP into mutual fund, that's an asset creation. Also, purely from numbers perspective, currently in India, the rate of expense on insurance is fairly high. Therefore, irrespective of the offers that you have from insurance at this point of time, consider investing in mutual funds. Since your goal is long term, consider doing a systematic investment plan, SIP, into an equity based fund. If you have skills and time, you may want to go for actively managed funds. Otherwise, you can stick to a passively managed index fund.
All right, last question on the show. Karthik has written in, Karthik with a C. He says he's 34 years old. He has an annual income of 14 lakh rupees. He pays 45,000 rupees every month as an EMI. And he has a 5-year-old child. He'd like to put some money away for his child and his own retirement. Where should he start investing his money? So, Gaurav, he hasn't told us if he has life insurance, if he has health insurance, if he has an emergency fund, even though we keep repeating these things on the show week on week. Karthik, you need to have those things first. Assuming he's had those set aside already, Gaurav, where should he invest his money?
Karthik, couple of things. One is great that you are earning well and there's also a decent rate of saving. You already have certain kind of loan. You are looking at child's education and retirement, which is great thinking. Few clarifications. You never invest into insurance. Insurance is a cost, that premium that you are paying. While everybody needs to have insurance, but not from investment perspective, it is purely from the perspective of covering risk of death. So one, I would encourage you to go for term plan and if possible, take a call on your ULIPs. Now, when it comes to investment, since your child is only 5 years old, and the higher education need will be at least decade or more away, you may want to start doing an SIP, a systematic investment plan investment into an equity based mutual fund on regular basis. If you have skills and time, go for an actively managed fund, else opt for an index fund.
All right, so that's a wrap on Investor's Guide. Gaurav, thank you for answering all of our questions. If you have a question about anything to do with your money, whether it's loans, whether it's tax, whether it's saving, investing, spending, write to us. Email ID is at the bottom of your screen. And we will be doing an insurance special on 30th of August. That's next week. You can catch that show at the same time. And of course, you can send in a question. If there's something that worries you about your insurance policy, we're here to help. You can reach us on Facebook and you can reach me on Twitter. Thanks so much for watching.